Let's talk family trusts for medical professionals. I'm George Duby, saving the world from tax, one bow tie at a time. So, why would a medical professional want a family trust? And maybe even more importantly, what is a family trust? So, initially, that family trust I like to describe as a relationship, and it's defining who is eligible to receive, not required to receive, assets or income down the road, and who is going to control those assets. So, in a stereotypical situation, it's often mom and dad who are controlling assets, but they don't own the assets. For many medical professionals, the family trust will not be allowed to own a professional company. But that family trust can be instrumental in saving taxes and creating a legacy with respect to the profits over time from that professional company. So, in terms of why that medical professional, you, and your family may be looking for a family trust, let's remember most of the professional bodies across the country, the different provinces and territories will have separate rules as to who can own shares of your professional company. Often it may include a spouse, but rarely does it include the children owning common shares of the company. Having the ability to put investments in a separate investment company, which in turn is owned by the family trust, starts to let the tax savings slowly trickle and accumulate and accelerate as time progresses. So, why do we want a separate investment company from the professional company, assuming it's a PC or some other form of operating company with restrictions on the shareholding? In a long term perspective, it's to say when the second of the spouses passes away, assuming that all of the assets from the first spouse to pass away through the will go to the surviving spouse. When that surviving spouse passes away, from a tax perspective, all of the assets of an estate are deemed to have been sold for fair market value. So now, where there's been investments at the corporate level, those shares are deemed to have been sold and taxes may be payable. Often, that tax rate is a real rough number, maybe approximately 25% of the value of the company. On the other hand, if we were able to begin transferring the investments to a separate investment company owned by a family trust, nobody owns the shares of the family trust. In other words, the second of mom or dad passes away, there was nothing to dispose of, nothing Revenue Canada deemed to have been sold. Therefore, more assets are able to get transferred to the next generation. In effect, a supercharged RSP in many ways, without a lot of the negatives associated with RSPs. Further, this isn't just something that we're doing waiting for mom and dad to pass away. During the lifetime of the shareholders or the trustees or the beneficiaries of the trust, depending on which group we're referring to, additional tax savings may be available. Additional savings are available when we combine this strategy with some of the what I will call using other people's money to pay for taxes and using something, I'll call it a TOSI trust with a bow tie. But we have separate videos for those as well. Let's focus on the family trust right now. So a good question is, when should we set up a family trust for healthcare practitioners? And the answer in my mind is probably sooner rather than later, if we're trying to get as many benefits as possible over a longer period of time. So as an example, someone just starting off, I appreciate initially there's not necessarily a whole lot of investing going on. But if we're allowed to have those investments percolate over time, appreciate in value, begin spitting off some investment income, it's going to be faster and more tax efficient to do initially. In many cases, someone may have already been practicing 10, 20 years, maybe longer. And it still makes sense to set up the family trust. But now we have some additional transfer costs that are applicable. And we've had a lot of that percolation time, of course, now made unavailable to us. Not the end of the world. We just missed a little bit of the opportunity. It's like a common question. When should you invest? Yesterday is always typically the best answer, but today is the next best choice. And I would suggest the same with family trust. Yes, it makes more sense where there's children involved, but quite a number of our clients don't have or don't expect to have children. Maybe they're more concerned at that point, nieces, nephews, church, cancer society, whatever it may be. It's fairly unlikely, though, that your primary thought process as you accumulate some net worth, look after your retirement needs, which the trust helps with as well, particularly in combination with the professional company, but unlikely you're looking to give more money to Revenue Canada. The family trust can be an instrumental tool in assisting not only with retirement planning for the professional and their spouse, but as well some estate planning availability or additional benefits are available through the family trust. It may not be the most important thing for you, but often it's one of the prime considerations, even when somebody's starting off their practice, to be thinking ultimately, at some point, I want to be able to retire and do some of the other things that perhaps you don't get the chance to do through your career. Using the family trust can help make this a little bit more efficient and therefore make your dollar stretch further. To emphasize, while I think most people should start that family trust very early in the process, from that tax savings, investment percolation idea, and there can also be potentially some legal advantages to doing so. One of the common tax questions out of that from a mathematical perspective that I'll receive is something to the effect of how much an asset should I have before it makes sense? And let me go back to an earlier comment where upon death of, typically speaking, the second spouse, if roughly speaking, we're now going to have to give away 25% of our estate in relation to the investments, that's a big number or a big percentage. So it doesn't take much of a number before saving 25% of that makes the trust more than worthwhile, ignoring all the other benefits of the family trust. So let's get a more precise example. You have or expect to have in the future $1 million, whether that's traditional investments, alternative investments, real estate, whatever. It could be a hula hoop factory. But saving 25% of that $1 million, to the best of my knowledge, $250,000, to me, That's pretty easy math to say, I want to save $250,000. I've painted a lot of rainbows and lollipops with respect to the use of a family trust. There are three primary disadvantages I will suggest. First is the cost in setting up a family trust. Not that it's exorbitant, but it's certainly more than just setting up a corporation. Second disadvantage, it's a bit of a pain in the rear end to set up. It takes some extra time. It's generally at least a 3-month process. And there's certain hoops and hurdles that we need to go through to make sure it's done properly. There's about a half a dozen things that if we do incorrectly, it will forever taint that trust, make it useless. So we're going to slowly, methodically go through our checklist, make sure it's done correctly, because I do not want to be in a scenario 10, 20 years from now where we're having a discussion, something to the effect of, gee, George, you messed up this. And I have to reply, but yes, but we saved 2 weeks' time getting it ready for you. Third disadvantage is that the family trust is good for 21 years. It's a long time from an investment and a business perspective, but a short time frame from an intergenerational perspective. So what happens at the 21-year anniversary is that if we do nothing with the trust, all of the assets within the trust are deemed to have been sold for fair market value, in most cases, a tax disaster. So instead, typically, we will remove the shares of the company owning the investment holding company effectively to one or more of the beneficiaries of the trust. And when properly done, this can be done without paying any income tax, as if that beneficiary was the original owner of the shares. Then, in many cases, we will do something I'll call refreeze the company, essentially meaning we're going to set up a new family trust and start again. So every 20-ish years, we're going to go through the process again. And some people may not be thrilled with that. And again, I'm not pretending it's perfect, but I would suggest to you that in most corporate situations, every 10, 15 years anyway, there was going to be a change in tax rules, legal rules, family situation, investment situation. Something was going to generate a required change. This just locks us into every 20-ish years. Not the end of the world, but let's not pretend it's perfect. There are a number of aspects of the family trust we'll have to discuss as we go through the creation process. So we like to be able to quarterback that process, working with your legal team, and help you decide, for example, who are going to be the beneficiaries. Most of the time, we'll see mom and dad, kids, grandkids, whether born or not. In some cases, it may be expanding beyond that. Perhaps, for example, you practically speaking raise the neighbor's kid as your own. And there can be other scenarios, but we want to be able to define that, because once we've set that trust up, it's really challenging to change anything of significance to it. We're also going to go through who the trustee should be and different positions with that trust, and a settlor and an advisor. But these are things we can hold your hand through, talk about the pros and cons, and allow you some time to figure out, based on those pros and cons, who you think would be the right person so we can tailor that trust to your specific situation. So this has been a very high-level discussion about family trusts and why you as a medical practitioner and your family can benefit from them, not just today, but also down the road. Please take the time to subscribe as we update information, as rules change, and to get a hold of additional complementary information that could really, really drive some of the benefits of your family trust. If you'd like to talk more about family trust, please use the information below and let's start that process. Have more questions? Please subscribe, follow, and even share. I want all of us to have the tax information we need to do wonderful things.